This analysis is for informational purposes only and does not constitute investment advice. In late 2023 and 2024, institutional investors operated under a specific assumption that generative AI posed an existential threat to Google's search monopoly. The 2025 financial results told a different story. Alphabet generated a record $403 billion in total gross revenue. Core search remains the dominant financial driver, accounting for 56% of that revenue stack, proving the anticipated cannibalization failed. Search revenue reached $224.5 billion, maintaining a 13.4% year-over-year growth rate. Even as alternatives emerged, Google's top-line volume continued to expand. Integrating conversational AI did not erode Google's 90% market share. Instead, the move toward complex, multi-step queries expanded the total addressable market for the entire search segment. The rollout of AI mode began a transition toward agentic search, where the engine performs tasks rather than just finding links. These complex interactions are 3 times longer than traditional keyword searches. Longer conversational queries allow users to resolve complex commercial intents in a single session. This allows Google to monetize intent-driven searches that previously generated no ad revenue at all. This chart tracks the result of that transition: pricing power. The yellow line shows cost per click reversing a 7-year historical decline and stabilizing at a positive 7 to 8% year-over-year throughout 2025. YouTube complements this growth as a $40.4 billion dual-engine business, generating revenue through both high-margin subscriptions and targeted advertising. While the U.S. election cycle pressured YouTube's ad growth, the platform successfully addressed its primary internal monetization friction this year. By the fourth quarter, YouTube Shorts reached revenue per mil parity with long-form video. The drag created by the shift to short-form content has effectively been neutralized. Google's advertising mechanisms successfully absorbed 2 major structural shifts: conversational chat and short-form video, without losing their underlying monetization capacity. Managing over $400 billion in revenue requires massive global infrastructure. Yet Alphabet achieved this scale while stabilizing its total headcount at roughly 185,000 employees. Operational efficiency is visible in the margin data. Despite the AI infrastructure arms race, consolidated gross margins recovered from their 2020 lows to hit 59.7%, the highest level the company has seen since 2016. This translated to record-breaking operating income. Alphabet generated $129 billion in EBIT for 2025, reaching an all-time high operating margin of 32%. This margin expansion was driven by deliberate structural changes, including the removal of bureaucratic layers and a measurable acceleration in product release cycles. This level of operational leverage allows Alphabet to self-fund its massive research and development efforts without diluting equity or relying on outside capital. While search provides the capital, cloud has become Alphabet's primary engine for absolute growth in the enterprise sector. Google Cloud reached $58.7 billion in revenue for 2025, a 35.8% year-over-year climb. The fourth quarter saw a massive acceleration to 47.8% growth, driven by enterprise adoption of Gemini and Vertex AI, the tools customers use to build their own autonomous agents. Beyond pure growth, cloud achieved a critical financial inflection point this year: the shift from a subsidized loss leader into a primary profit engine. The shift in profitability is stark. Cloud operating margins crossed 30% in the final quarter, generating over $5.3 billion in operating income. Reaching a $70 billion annualized run rate with 30% margins validates Alphabet's infrastructure strategy. Enterprises are now using Google Stack as the foundational layer for the next wave of agentic AI software. Maintaining this position in the AI infrastructure oligopoly comes with a staggering price tag. Alphabet is currently in the middle of a massive capital expenditure supercycle. Alphabet's CapEx hit $91.4 billion in 2025, consuming 23% of revenue, driven by high-end AI chips and energy infrastructure. This creates the CapEx Paradox. Notice the extreme gap between this massive investment and the gray depreciation bar, remaining low at 5.2%. This gap indicates an impending wave of accelerated depreciation. As this new hardware ages and server useful lives are shortened, the resulting costs will place significant downward pressure on operating margins. The core question for investors is whether AI-driven revenue can grow fast enough to offset the sheer weight of this looming depreciation cycle. Leadership must now balance these aggressive infrastructure investments with the need for disciplined capital allocation. In 2025, Alphabet managed to fund its $91 billion CapEx cycle while simultaneously returning $45.4 billion to shareholders through share repurchases. While internal management remains disciplined, the primary external threat to the business remains the ongoing Department of Justice antitrust litigation. Judge Mehta's September ruling removed a major valuation overhang by avoiding worst-case structural remedies, such as the forced divestiture of Chrome or Android. However, the mandated behavioral remedies, including a ban on exclusive search distribution deals, represent a structural vulnerability to Google's historical monopoly mechanics. Alphabet ended 2025 trading at a forward price-to-earnings multiple of approximately 25. For a company that generated $116.4 billion in net income and an adjusted EPS of $9.52, a 25x multiple is historically consistent with its status as a protected monopoly. Free cash flow compression now stands as the primary structural risk to this valuation. In 2026, CapEx is projected to surge to between $175 and $185 billion. This massive increase will consume a higher percentage of operating cash flow, potentially limiting the company's ability to sustain its historical level of share buybacks. Investing at today's valuation requires conviction that these data center investments will deliver high returns on invested capital within a clear payback period. 2025 was the year Alphabet proved its core advertising business could withstand the most significant technological paradigm shift since the rise of mobile. Looking toward 2026, the strategic focus will shift from the deployment of foundational models to the broad consumer monetization of the agentic AI features built on top of them. The definitive test for the stock will be proving that Google Cloud's 30% margins are a permanent structural feature and not a temporary anomaly of the investment cycle. Alphabet remains a dominant monopoly navigating intense friction. Its future depends on successfully balancing unprecedented capital deployment, the demand for immediate shareholder returns, and the increasing scrutiny of global regulators.